Stonks, Lambo, tendies. These are the words that are now associated with the stock market following the explosion of a well-known subreddit during the last few years that we'll be diving into in just a little bit. We're seeing fewer people talking about Warren Buffett and more people talking about the man known as the Roaring Kitty. Today, we're going to be diving into what the heck has happened to the stock market over the last few years. And we're also going to be talking about how retail traders have shifted from a generation of wealth builders into a generation of gamblers. Buckle up, everyone, because this one's going to be an eye-opener. Let's kick things off by talking about options versus stocks. Options can be incredibly dangerous due to the leverage that's involved with them. With as little as $100, you can control $10,000 worth of stock. Sounds exciting, right? Wrong. If you're a gambler, you likely don't actually have the $10K to back it up if things go south. The key difference: when you buy stocks, you own a piece of the company. With options, you're essentially borrowing someone else's shares, hoping to profit from them. At its simplest, options are just betting on the performance of a stock that you don't own. It's less of an investment and more of a gamble. Now, if you don't know what a P/E ratio, volatility, or EBITDA is, you probably shouldn't be trading options. Yet, with the laxness of opening up options accounts, pretty much any 18-year-old with a pulse and $100 has access to instruments that just a few decades ago, you'd need to be a hedge fund manager to have. Today, regular people think that they can outsmart the billions, if not trillions of dollars that hedge funds and brokers spend on research and algorithms. It's like thinking you can beat the casino. And it's exactly why I was doing this on a daily basis when I was active in my gambling. Because I'm Rob, and I'm a recovering gambling addict. For a really long time, I thought that, hey, this has to be better than sports betting or playing casino games. But the truth was that I was trading options and getting involved with risky stocks because I wanted to keep gambling. As a gambling addict, we try all kinds of things to get ourselves to feel better about the actions that we know deep down are wrong. For me, it was going to the stock market instead of betting on sports because that was more sophisticated, right? Remember, the house always wins. Or in this case, the broker always wins. Since I brought it up in that story, let's talk about day trading. You might hear success stories, especially from people who are trying to sell you a course on technical analysis. But here's a reality check. 99% of day traders lose 99% of their money within the first 90 days. You don't have the insider information or sophisticated tools that these big institutions have. And a lot of times, it comes down to dumb luck and market movements that, unfortunately, is interpreted falsely as having some kind of skill, which convinces you to try your luck again. Technical analysis is often unreliable, and most people doing options don't even understand the fundamentals of, say, fundamental analysis. For example, many people base their options contracts on earnings reports without considering outside market fluctuations, company changes, or the broader economic trends. This lack of depth leads to massive losses, and these losses, they can happen instantly. One of the most striking examples of gambling in the stock market was the Wall Street bets craze with GameStop and AMC specifically. Many people, attracted by the potential of quick profits, jumped in without understanding the risks. This led to significant financial losses when they bought in too late. And now they're referred to as bag holders, as they're still holding on to their assets years later down the road, where they are now down a huge amount on their initial investment. They're just hoping that some miracle can get them their money back. These scenarios appeal to those who don't understand the implications of day trading and options. It's like seeing everyone win at the casino and thinking that you're gonna be next up. The money has to come from somewhere, which is why so many financial institutions are out there writing options contracts that retail traders will buy that are deteriorating in value every single minute that they're being held. Desperation also played a role, especially during the pandemic when people received stimulus checks and they were looking for ways to make quick money to supplement their income. It's really similar to gambling, risking money that you can't really afford to lose in hopes of a big payout. During that time, many people turned to trading as a replacement for sports betting. With sports events on hold all around the world, the thrill seekers found a new playground in the stock and options market. This shift highlights the gambling mentality, seeking quick wins and the adrenaline rush, often without fully understanding the risks involved. People were spending massive amounts of money with very little knowledge. And even if the risks are understood through repeated losses and experiencing pain, a lot of times continuing is justified by saying, well, this is the stock market. It's not gambling. This is much more sophisticated, and I'm gonna get better at it and things will be different next time. Options trading has become accessible to almost anyone, but this accessibility comes with significant risks. With naked calls and the ability to trade from your phone, people can make life-changing financial decisions in seconds, literally seconds, because brokerages like Robinhood also offer instant deposits, so you don't miss the action. The speed at which you can lose money with options is staggering. You can go from being up thousands to having a negative balance of thousands in no time if you're utilizing margin, which is essentially borrowing from your brokerage to increase your buying power. It's like a cash advance at a casino or a marker. Some traders, like myself, even gambled on zero-date options during things like Federal Reserve meetings, trying to profit from the market's reaction to economic policy changes. This is just like betting on a horse race without knowing anything about the horses or the track. There were so many times, pretty much every Federal Reserve meeting, where I would watch and listen to these economic policies about interest rates and bonds and things that I really didn't understand, and I'd be watching the index go up and down with the market sentiment. I was just hoping that somehow, some way, my coin flip decision of whether it would go up or down would end up making me profit. But a lot of times there'd be a huge initial market movement followed by a correction, and by the end of the day, I would usually have ended up losing money regardless of which way I thought it was going to go. Realistically, things can change in an instant. And when there's major events like the Federal Reserve meeting that are going to determine what everyone's going to do with their money, you can pretty much be assured that you're going to lose if you play it. Also, let's not forget about the tax implications. Short-term gains are taxed at a higher rate than long-term investments. This can significantly impact any profits you were lucky enough to find during short-term wins, day trading, and is another reason why consistent long-term investing often beats the high-risk gamble of day trading. This is an important point. I am by no means telling you that all investing is gambling. We need to touch on the difference between a retirement fund and a day trading account. Consistent long-term investing harnesses the power of compound interest, whereas day trading relies on timing the market, which is incredibly difficult to do. There has actually never been a 20-year period where the stock market has had a negative return, despite what we consider to be financial crashes. So holding assets and collecting dividends for many years will allow you to build and maintain wealth. However, trying to change that 20-year period into a 20-day period is sure to cost you dearly. Studies show that regular investment over a long period of time significantly outperforms attempts to time the market. Or in other words, time in the market beats trying to time the market. The stock market and gambling share more similarities than you might think, especially when it comes to options and day trading. Remember, while both can be thrilling, they come with significant risks. And if you're taking financial advice from a guy named Roaring Kitty on a subreddit called Wall Street Bets, you're probably going to end up losing money. Always do your research and consider the long-term implications of your financial decisions, because that's not something that I did for many years and it cost me a ton of money. Don't let the same thing happen to you. If you feel like you're not able to control yourself with day trading or other forms of gambling, then it might be time to consider trying to quit gambling. And if you're looking for steps on exactly how to do that, check out this video that I made on my 4-step process to quit gambling. And until then, let's keep getting better together, one day at a time.